The Dow Jones and the S&P 500 close higher as big banks gain after clearing the Fed's annual stress test. Strong economic data soothes recession fears. Stocks in the Asia-Pacific trade largely lower, while the adjusted SGX Nifty for Nifty futures is signaling a higher start for the Indian market. Oil closes marginally higher after a choppy session as fears over rising interest rates denting global economic growth offset expectations of higher demand in the US. Market regulator SEBI cuts the time period for listing of shares post-IPO to 3 days from 6 days earlier. Also amends FPI disclosure norms for those holding 50% of Indian equity AUM in a single corporate group or over 25,000 crore of equity AUM in the Indian market. Chairperson Madhuri Booth also says new draft total expense ratio regulations will be published soon. The government postpones the implementation of tax collected at source under the liberal remittance scheme to the 1st of October. The finance minister says there will be no change in rates for payments up to 7 lakh rupees, while overseas credit card transactions will not be subject to the levy. Speaking at the TCS AGM, new CEO K. Kriti Vasan says the company has returned over 90% of cash generated to shareholders. Chairman N. Chandrasekharan warns of downside risks to global economic growth and says that AI and machine learning will have a profound impact on business. Good morning in the Mumbai News Center. I'm Sonal Bhutra. You're watching Power Breakfast. Those are the top headlines. It's a Friday morning. We come back after a day's break, so we have a lot to catch up on. But first up, as always, let's take a look at what the Asian markets are doing. They are quite mixed right now. So we do have the Taiwanese index, which is lower in trade right now, 0.6% there. But the Hang Seng is flat with some positive bias. But we have to say that it is a mixed picture in the Asian markets. Shanghai is higher in trade. Kospi 2 up 0.4%. And we do have the Straits Times, which is higher by 0.3%. The SGX Nifty, that will come up for you on the screen, and that one adjusted for Nifty futures because we were not trading yesterday, is indicating that the start for our own markets, yes, well, it could be in the green. Around 100-point uptick is what this one is indicating. The Chinese June manufacturing PMI has come in absolutely in line with estimates. US markets also did well, so looks like it could be another day in the green for our own markets. Let's talk about that then. Wall Street ended yesterday's trading session mixed. The Dow Jones closed nearly 270 points higher and the S&P rose by 0.5%. Meanwhile, the tech-heavy Nasdaq was the day's underperformer, closing flat. Investors will closely watch personal consumption expenditure index data due to be released later today. Note that PCE is Federal Reserve's preferred inflation gauge. In fact, let's also listen into some important voices on where the market is headed and the Fed's next move.
We are after the inflation spikes and the majority of the Fed hikes, but we are probably before a more pronounced economic slowdown and a more pronounced profits slowdown. So it leaves investors in a little bit of no man's land. Should I stay or should I go? And I think the reality is, if we look at the majority of the market, it's relatively stable outside of course, the surging 7 stocks. And I think that is a good thing because it means valuations are near their long-term averages. So we're not seeing too much overpricing in that segment of the market, which is the majority of the market. I'd also say, look, investors should be a little bit primed for a pullback in the second half of the year and expect some volatility. But I don't think we're going to need to retest those October lows from last year.
Now, in terms of the Fed, yes, we do expect the Fed to actually go twice more. The markets have moved in line with those expectations. We've been arguing that the bar for July is quite low. So especially after these data, we think a July hike is quite likely. And then we have one more in September, which could potentially be pushed out to November. But I think the point is where the terminal rate ends up. And we have that at 5.5 to 5.75%.
Okay, that is some market opinion, and that's the global market action as well. But how will these cues impact our own markets? We have a research team joining in to tell you just that. The trade setup, the stocks that are likely to be in the news, and the action from the F&O space as well. Hey guys, a very good morning to you. Rima, let me come across to you first up. What is the market setup looking like today?
Well, it's looking pretty good because the SGX Nifty is suggesting a start around 19,200, which if you compare with Wednesday's future close was at 19,082. Which means the SGX Nifty is pretty much suggesting a gap-up opening of close to about 110 points, right? Because yesterday, markets were shut, When you look at the global cues over the last 2 days, because the Indian markets today will be reacting to how US closed on Friday and Wednesday. Well, Wednesday was absolutely flat. And yesterday, as we've been highlighting, you had strength on the Dow, you had strength on the S&P, though the Nasdaq closed pretty much on the flatter side. The economic data coming out of the United States, whether it's the jobless claim, whether it's the Q1 GDP number, all seems to suggest that the US economy is currently in a fine fettle. For our own markets, on Friday, what a blowout session, literally a dream session for our markets. We conquered our all-time high levels very early in the morning session, and we went to build on that strength. 19,000 taken on the Nifty on an intraday basis. We closed just shy of that. But today, of course, given what the SGX Nifty is suggesting, it will be opening well above that. Look at the flow numbers. The FIs on Friday bought close to 12,000 crore rupees in the cash market. The DII selling was only 1,000 crore. But bear in mind, the FI inflow on Wednesday of 12,000 crore rupees would include the Adani block and the MSCI rebalancing. We start the July series, today, and the July series is an important one because you will have the Q1 earnings picture from next week. In fact, Chalet Hotels will be reporting numbers. The one after that, TCS and HCL Tech. So you've got the earnings season, you've got the progress of the monsoon to track, you've got another FOMC meet. So the July series will kickstart today, an important one. But this is how we've wrapped up the June series. Back to you.
Okay, all right. Thank you, Rima, for that. So those are the market cues to watch out for, but a lot of stocks in focus as well. Abhishek is joining us.
Well, to begin with, MCX has decided to extend support services being rendered by 63 moons for another period of 6 months from July 1st. So earlier, they had extended the service from January for a period of 6 months. BPCL board has approved fundraise of about 18,000 crore via equity shares. CNBC TV18 has accessed 4 observations issued to Aurobindo Pharma's Ankalpally unit. So over there, the inspection was done from May 15 to May 19th of 2023. ICICI Bank, they have approved draft scheme of arrangement for delisting of ICICI securities by issuing shares. So they will issue 67 shares of ICICI Bank for every 100 shares of ICICI securities. Now, sources on various stake sales for TD Power, promoter and shareholders will sell about 24.2% stake, which is worth about 800 crores via block deal. It is being offered at a discount of 4%. Credit Access Grameen, the promoter will sell about 5.8% stake, worth a little more than 1,100 crores. The price, being fixed over there is about 1,230 as the base price. Tata Communication, they have acquired Kalrea Incorporation for an all-cash deal by a payout of about $100 million. Power Grid, there is a board meet which is happening on 28th of June to consider various investment proposals. So for telecom network for NTAMC, which is at a cost of about 164 crores. Also for Western Region Expansion Scheme, which is at a cost of more than 115 crores. And approval for ICT augmentation at Navsari, which is at a cost of about 110 crores. So Shree Cement over there, Shree Cement East Private Limited has commenced trial production at its clinker grinding unit in West Bengal, which is at a capacity of 3 metric ton per annum. With this, the total cement capacity for Shree Cement has gone up to 49.9 metric ton per annum in India. Back to you.
Okay, all right. Those are all the stocks that are on our radar today. Let's talk about the F&O space now. Nigel is joining us with cues from that space. Hey, Nigel.
Well, morning, Sonal. We've been gaining for the last 3 sessions. Can we make it 4 in the row? Well, that's something that we'll be looking forward to. The big cues really will be the Fed, the progress of the monsoons, earnings season, as well as the HDFC merger. So those are the top 4 cues that we're looking out for in this series itself. How the FI is positioned? Well, they position net long. Close to around 66% of their positioning is on the long side. And if you look at the net long positions, I'm talking about the longs minus the shorts, well, it's at around 56,000 contracts, which is much better than we saw at the start of the last series of close to around 20,000 contracts. The problem is the PCR has moved to the upper end of the range at around 1.41 odd. Remember, the range is close to around 0.7 to around 1.4. And we have seen in the past when we go to 1.45 odd, that's when we see some bit of profit taking. So let's see how it goes this time. It seems the bulls are feeling very, very confident because now, in fact, the put writing is really taking center stage. And just take a look at the big open interest build up on the put side. And the call side, well, it pales in comparison to the put side. Now, you need to stay long on this index. But I think just for today, taking some money off the table at the gap up will be something that you should be looking at, going by the cues. But if you're looking at stop loss and on the downside, what should the support levels be? I think the 20 DMA is an important level. So the SGX Nifty should come up for you on the screen. We have had 3 good series. This morning as well, it's suggesting some bit of green to kickstart trade. I think take some money off the table, have an early weekend. Back to you.
Okay, all right. Thank you so much, Nigel. So those are the cues to watch out for today's market session. Let's slip into a short break. Up next, we'll get you all the updates on TCS, that is the tax collected at source, as the government postpones implementation of new TCS rates. Stay tuned for that. Welcome back. You're still tuned into Power Breakfast on CNBC TV18. Let's get you some updates from the TCS EGM that was held yesterday. The first under new CEO K. Krithivasan. The TCS top brass spoke of a macroeconomic overhang throughout the year. CEO Krithivasan said they returned over 90% of cash generated to shareholders and recorded a strong order book throughout the year with a total contract value of $34.1 billion. Chairman N. Chandrasekaran warns of downside risk to global economic growth and says that AI and machine learning will have a profound impact on business. The Tata Sons chairman also expressed deep pain over the job scam that emerged at the IT major. Okay, with that, let's move on from this TCS to the other one, that's tax collected at source, as the government has postponed the implementation of the new tax collected at source under the liberalized remittance scheme to the 1st of October from the 1st of July earlier. The Finance Ministry has also said that there will be no change in the tax collected at source for payments up to 7 lakh rupees, while in an important clarification, it also says that overseas credit card transactions won't be counted under the LRS scheme and hence will not be subject to TCS. Well, this is a big update that came yesterday, so we'll keep tracking that for you. But let's move on. Market regulator SEBI cleared an array of proposals at its board meeting held on Wednesday, which include halving IPO listing time to 3 days from 6 days at present. The board also approved making additional disclosures mandatory for certain FPIs. SEBI chairperson Madhapi Puripuj in her press conference said that the issues around mutual fund TER regulations were discussed extensively in the meeting. Let's listen into what she had to say.
Proposal was discussed in depth, and the board finally advised SEBI to go back and publish it as another consultation paper. Reason being that, as I had mentioned earlier in some forum, that unlike our normal proposals which are done by way of co-creation with the industry, since this was a price-sensitive subject, we did it with the limited data that we had and without the benefit of the data that the industry had. So once our consultation paper was there, then naturally industry came back with their granular data. Now when we saw that granular data and said, okay, we now understand this, so therefore a lot of the things that we had built into and baked into our original proposal needed to undergo a change. We modified the proposal, and the proposal was actually, I think the industry would be quite pleased to see the new proposal. And therefore what the board said was, look, the proposal has undergone significant change because, as we described, we had more data, new data, and therefore we obviously, as I've always said, that the data will speak. So our policies will always rely on data. And therefore the board advised us that publish your new proposal, which you have put to the board, publish it again to the industry, and let us see now with this fresh proposal, which is quite different, let's see what the feedback is.
Okay, important update there. Of course, we'll analyze that as well for you. But time for a short break. When we return, the Reserve Bank of India released the Financial Stability Report for June. We get to the details on the other side. Stay tuned. Welcome back. You're watching Power Breakfast on CNBC TV18. RBI's financial stability report shows that the stressed assets in the banking system have dropped below 4% as of March this year. It is expected that the asset quality will improve below 3.6% by next year in the baseline scenario. My colleague Ritu Singh brings us more clarity on this.
Well, the big takeaway that comes through from RBI's financial stability report is that banks are well capitalized and capable of absorbing any macroeconomic shock over a one-year horizon, even without any additional capital infusion, and bad loans could actually fall in the baseline scenario assumed by RBI. Now, the regulator paints a very positive picture of the banking system outlook. The capital adequacy of banks and the CET1 ratio currently at historic highs, the gross NPAs at a decadal low of 3.9% with net NPAs at 1% as of March, and the macro stress test that RBI has conducted assumes certain levels of macro shocks to the economy to ascertain how resilient the system is, and finds that gross bad loans of all banks could actually fall from 3.9% as of March to 3.6% by March next year in the base case scenario, and rise marginally to 4.1% in the medium stress and 5.1% in the severe stress scenario. Now, if you break that up across various bank categories, public sector banks could see their gross NPAs rising from 5.2% now to 6.1% by March next year in the worst case scenario, or improve to 4.8% in the baseline case. Private banks could see their gross NPAs fall to 2.1% in the baseline case and rise to 3.8% in a severe stress case. Similarly, for foreign banks, NPAs could rise in the worst case to 2.6% by next year. Now, in terms of capital adequacy, the stress test results show that banks' capital adequacy overall could fall from 17.1% now to 16.1% in the baseline case and 13.3% in the severe stress test case. However, none of the 46 banks will breach the minimum capital requirement of 9% in the next 1 year, even in a very stressed scenario, although 7 banks could fall short of the minimum capital when you include the capital conservation buffer in the severe stress scenario. For NBFCs, RBI has taken a sample of 135 large ones, and in the baseline scenario, their gross bad loans could rise from 3.4% currently to 4.1% by March next year, and in a severe stress scenario, it could even double. In terms of capital adequacy, it could fall to 24.4% in the baseline case, 23.8% in the medium case, and 23.5% under severe stress. As many as 5 NBFCs could fail to meet the minimum regulatory capital requirement in this severe scenario.
Ritu, thank you so much for joining us with all those details. With that, we'll take your leave on this edition of Power Breakfast. Stay tuned. Bazaar Morning Call comes up next.